All right. Good afternoon again, everyone. My name is Don Noble. I'm going to be moderating this next panel discussion. I'm going to take a second and talk with each of our panelists. Seth, good morning. Seth is Executive Vice President of Thermo Credit. Seth, would you mind giving a little bit of your background?
Sure. My name is Seth Block. I'm the Executive Vice President at Thermo Credit. We are an asset-based lender, and also we do factoring. What is unique about us is that we focus in on one industry, which is the communications technology industry. We really like that space. We come from that space, and we've been doing this for about 20 years.
Terrific. Thank you, Seth, and thank you for joining the panel today. Darren, Managing Partner, Commercial Finance Partners. Thank you for being here. Why don't you give us a little bit about yourself?
Thank you. Commercial Finance Partners is a direct lending and advisory firm. We provide small business loans, similar to what Seth does. We provide accounts receivable financing and asset-based lending. And then if something is not a fit for our balance sheet, we help our clients obtain capital through a variety of different resources and focus all over the United States in all different industries.
Terrific, Darren. Thank you for being here. And Aaron Jarrett, Principal of Ovation Partners, would you give us a little bit about yourself?
Yeah, here at Ovation, we are a private credit fund. We focus on small and medium-sized businesses that need help with funding. We provide funding all through the capital stack, either first lien, second lien, subordination debt, or all the way up to equity. We've partnered with just over a dozen companies over the years, and we've helped them either obtain financing through traditional banks and moved further down the capital stack as they continue to grow and progress, or we've maintained our current position as we've helped them grow and become more sophisticated. One of the things that we do as part of any line of credit or investment that we give is we also provide our expertise and experience in the industry and market to help them, further round out and increase their ability to perform well in the market.
Terrific, Aaron. Thank you very much, and thank you for being here today. What a great set of panelists. I'm sure everybody's going to get some value out of today's session. Let's start with we had some questions come into us before the panel started, so I want to go through a couple of those. Seth, I'll start with you. What does working capital mean to a company, and why is it important?
Well, working capital is the capital that's available to a company to run their business. It's the capital they use to pay their vendors. It's the capital they use to pay their employees. It is the lifeblood of a company. And because of that, in my opinion, it is the most important thing. The lack of working capital puts all kinds of pressure on a business. They have to deal with vendors looking for payments because they can't pay on time. If they have stress on whether or not they can make payroll this week. So it becomes very debilitating if there is a lack of working capital within a company. So in my opinion, working capital is the most important thing.
I would tend to agree with that. As a CFO, we're always looking at working capital in the business. Darren, do you agree with that, and do you have some additional thoughts?
Yeah, most definitely, especially in today's environment where you have supply chains stretched out to the degree that they are. What we've seen, the working capital, call it problem, rear its ugly head more often than ever. I have a client now, Shark Tank graduate, and they have all the customers in the world that you would want, all the big box stores. They've got sales through the roof. However, they've got a very long supply chain that just eats up the working capital. So without the appropriate working capital resources, they would be dead in the water despite their success in accomplishing what's generally the harder part in getting into these customers. So especially the main point I wanted to add is, especially in today's environment with such a gap in the supply chain, suppliers requiring upfront payment internationally and the long shipping times and that sort of thing, working capital is absolutely key for a business to function.
Thank you, Darren. Aaron, I'm going to take those two and I'm going to add a little bit to it. Along with the supply chain, we're seeing lenders typically saying you need more working capital, not just 30 days, but 60 and 90 days because of the supply chain. Can you comment on all of that? Anything you'd like to add?
Yeah, I think the first thing I just wanted to touch on what Seth and Darren mentioned is, no business ever goes out of business if they still have cash. When you run out of cash, that's when you run out of business. And so having a very good understanding of how long it takes, what your receivable turn rate's going to be, how long you can extend payables is super important to be able to keep the lights on. From the perspective of seeing more requirements, all lenders and anybody in that space who is giving you working capital advances, either on receivables or PO financing, whatever it may be, they want to make sure that they're comfortable. And given the change in the market, as Darren had mentioned, with the lengthening of time of the supply chain, you see them wanting to make sure they're more comfortable so that that they can go to their credit committees and say, we've made our borrowers and our partners more stable. It just puts more pressure on you as a business to make sure you have that cash in place, and understanding, how long it really does take. And it puts a little more pressure on, the finance, the CFOs, the controllers, to make sure they truly understand the life cycle of their products and the time frame of everything. And it really has sort of sharpened some people's ability to understand how long it does take in a supply chain. How long does it, take to get my payables, repaid, to get my AR paid, something that they might not have had an understanding on before. So it's really sort of opened some of our partners' eyes in terms of how much they've got to work with.
Thank you, Aaron. Darren, I'm going to come back to you and extend that. If a company comes to you, let's say for some type of financing, and they are very knowledgeable about their AR time, AP time, the lengthening time, and so on, basically knowledgeable about working capital, does that make it easier for you to do your job and lend to them?
It does. It's lending certainly becomes a collaborative effort. If you deploy, working capital to a company and they're not managing the use of that capital, it can actually further exacerbate the issues they might be experiencing. So having a plan and a good CFO and a good path forward is critical for the correct usage of that working capital. Going back to that example I shared before, there's a working capital need just tied to a specific point in time from when the supplier is shipping the product up until where the goods are invoiced, because they have a receivable financing relationship. So applying that working capital correctly is key to making sure that business is able to then generate those receivables, which then add additional liquidity for the business moving forward. So having a plan is absolutely key.
Thank you, Darren, and I thank you for that quick plug on CFOs. Seth, going to you, you kind of, at the beginning, you said how important working capital is. It can definitely be a lifeline to a company. What other services would a lender offer to a client to help them improve the way they do business and increase profits?
Well, there's a lot of things a lender does. Typically, it's not, in some cases, it's on a consulting arrangement, particularly lenders that have a specific niche, like, for instance, transportation lenders. They will a lot of times offer other services within their offerings. But there's also services that lenders provide that they may not necessarily get paid for. And what I mean by that is a lot of times lenders can help with planning out working capital needs. They can help, even if you're looking at an acquisition, they can help understand a couple of things. One is, how much financing are you going to be able to get to complete that acquisition? And whether or not you're paying the right price for that acquisition. So I think lenders really bring a lot more to the table than just providing capital.
Terrific. Aaron, switching that to you, does Ovation Partners also help with additional services and then maybe outside partners? How do you feel about that?
Yeah, sort of as Darren mentioned, his opening, there are times when we have somebody that, a partner that comes in that may not have the ability that we can take on balance sheet. We can help provide a plan, refer them out to somebody else that may be able to assist until they've gotten some of their short-term issues resolved. I hate to say it's sort of everybody's got a different approach you need to take. Not every, every issue that would cause somebody not to be balance sheet eligible is defined in a box. You sort of have to take it one step at a time and see where they need help and what you can do to get them there.
Okay. Darren, I'm going to switch that to you, and I'm going to add to it. A lot of companies feel that a lender in general just comes in, evaluates a company, lends money, and then runs away. But in my experience, every lender is dedicated to the success of each client that they provide capital to or provide assistance to. Do you concur with that? And how does Commercial Finance Partners do that?
No, I do, and just like Don, just like I shamelessly plugged you a minute ago, I'll do it for ourselves. The reason behind forming this business and having both a direct lending and an advisory side was to take care of, was so I could be a one-stop shop for a small business needs. As Aaron just mentioned, not all needs are the same, and a client's needs evolve through your life cycle with them. So as Seth mentioned, there's assistance on a day-to-day basis. In some case, on a direct lending basis, you're helping your clients plan things out. And as you mentioned, you might not be compensated, but it's an overall collaborative relationship, like I spoke about before. And then ongoing, things come up. You could have a client that is financing receivables, and then they get an opportunity to maybe buy out a partner that helped them get started, and then you can fit it into a new vertical moving forward from there. So, overall, being able to be able to kind of service the wide range of a need that comes up is key, for us to provide value to our clients.
And that's what we would expect from a business partner, which is what I think most lenders are, most debt and equity partners are, especially in my field. Darren, I'm going to stick with you for a moment. What does a lender and what does your group use to determine the amount of capital to provide? And I mean, that's an open-ended question. I figure that's going to get us at least 20 minutes of conversation, but can you give us kind of a back of the envelope guide?
Sure. So it really depends on the product you're looking at. In our world, I kind of look at two different forms of financing to fill working capital needs. There's asset-based lending, where you can lend a percentage of collateral value. So you have receivables, you can lend or purchase receivables. You have inventory, you can lend against inventory. And then the flip side of that is there's cash flow lending, where you're lending against lending tied to historical cash flow and potentially future cash flow as well. So on the first side, on the asset-based side, we generally, as a lender, we lend a percentage of receivables. So if a company has $1 million in receivables, we can potentially set up a line of credit up to that $1 million mark, and lend maybe 80 to 90% of their receivables outstanding. Same goes for inventory, up to 50% of inventory costs. Those ones are much easier to benchmark. They're standard formulas that groups of us have used for years. And then there's deviations from those formulas. On the cash flow side, it gets a little bit more tricky. There's lending that's based purely on historical cash flow numbers, where you're just measuring the history of the business and making a loan based on historical values, which I think most groups use those metrics to make loans. However, if you think about it, especially in a very strange environment that we'll probably keep touching on during this meeting, in a very strange environment where there's uncertainty in the future, just using historical numbers is a little bit of a false barometer on where a business might go. And so you do have groups, lenders like us and other lending groups that will use kind of a combination of historical cash flow numbers as well as future predicted cash flow numbers in order to make a loan. And some will actually incorporate both products that I've just mentioned, both an asset-based loan and a term loan, to collectively meet the need. So, in short, there's a variety of ways to evaluate how you're going to deploy the capital, but it generally always comes down to whether it's asset-based or cash flow-based lending.
Okay, thank you, Darren. Seth, pardon me for a second. Take that, and if you have any comments on the amount of capital, but also, do you think it's important that the company comes to you and knows exactly what type of lending they need? Or do you think it's more they should come to you and know what the different types are, but have you help them?
I think that's very helpful. It's certainly helpful if they know what type of lending they need. So we're not explaining what is available to them. But that does happen all the time. They come to us and they know they need some working capital, but they don't know what types of working capital they qualify for, or, what kind of loans they qualify for. So, we're able to walk them through that. I know Darren does that, Aaron does that. If it doesn't fit within our boxes, we obviously refer those out then. I will tell you that, and just to expand a little bit on what Darren had said, talking about asset-based loans, when we do that, we do it as what we call just a borrowing-based facility. We look at the inventory, we look at the equipment, we look at the receivables. We assign a value to each one. We then do a percentage based on that value, and then we come up with a borrowing base amount. And that borrowing base amount works like a line of credit. If that amount is 800,000, they can borrow up to 800,000 as long as the borrowing base stays the same.
Sure.
So, and like I said, it's very similar to what Darren does. I just wanted to expand on it a little bit.
And Aaron, expanding from that, I know you said earlier that you build packages for clients. Do you prefer a client that comes in to you that knows exactly how much they need and what they need, or do you prefer a client that comes in and says, we think we need some working capital, help us design the final product?
Well, it's always beneficial to have somebody that you're partnering with that is aware of what they need, what they need it for, what their life cycles are, but it's not a necessity. It's something that we can help educate them through the process. If they're aware they at least have a need, that's, sort of step one. Acknowledge that you have a need so that you can move forward, find the right partner. If we're it, great, we'd love to help you. But, going back to what I said at the beginning, we will work with all of our partners, no matter what kind of investment structure we provide, to make sure that they, better understand not just, what Darren was talking about, whether or not it's asset-based lending or, cash flow lending, because those are two very different things. But it's also understanding exactly what those mean in order for you to be able to lend or to borrow against. So, if you've got an understanding that you need capital, but you really understand your business and know your life cycles, then you can understand how changes in your business will affect what you can borrow. But if you're not aware of what those changes can do, then there's also a further education that needs to get done. And it's not a hindrance. It's just, you've got to make sure that you hold the hand a little bit more as you guide somebody along to know, look, in 3 months and 6 months, if you see a slowdown, you're right on the edge of what's eligible. What we don't want to do is get into a position where you're defaulting on anything without you understanding why you would be. So, there's really no difference to us in terms of whether or not we'd work with somebody. It's more the willingness to learn. Can you take those steps? And do you actually understand your business enough to explain to us and show us what's going to happen? What are some scenarios that may happen? Because that really can materially impact how much is eligible to be borrowed.
A great answer, Aaron. Stick with me for a moment. A question just came in. It said, if a company comes to you and says, I need working capital, is that a warning sign?
Absolutely not. You can need working capital for, I'll give it to you this way. One of our biggest and most profitable factoring partners right now has come to us for an increase because they need a lot more working capital. And it's a good thing. It's because their orders have increased, and because of the supply chain issues that have been mentioned earlier, all of a sudden you've got an additional need for more capital because you have the opportunity for business. And they were able to explain after we walked through a little bit, what the time frame would be, why they're going to need more, how much more they would need. But coming to somebody and saying you need working capital is usually a really good thing. That, to me, is actually one of the biggest things that is great as a partner, is to, one, have the willingness to ask for the assistance and saying, look, we know we need this. We know that our life cycle of the business requires us to have the funding today, and we don't have that. And two, one thing that it also shows is their ability to understand that they either need it now or will need it in the future. So.
Okay. Seth, I'm going to come back to you for a moment, switching gears. The SBA loan program in general, and I'm a veteran, so I'm very familiar with the SBA program, can be used a lot for working capital and permanent working capital. Can you give us a little sense there of how you feel about the SBA program and how it can help companies?
So I've seen it be very helpful to companies when it comes to working capital. Obviously, not all companies qualify for it, but it's working capital that is structured on a long-term basis. The payback periods are very good. The interest rates are good. The only time that I find that it's not a good thing is if a company has kind of outgrown the SBA loan that they can obtain, and they're now looking for other capital. They can come to someone like myself or Aaron or Darren to do some asset-based lending or factoring. But you do have to do what they call an intercreditor agreement, or actually a subordination agreement with the SBA. And that really depends on the bank, how easy that is to get done.
Sure. So in my experience, it's very bank dependent because some banks are stronger in SBA and some are weaker.
Yep.
Darren, do you concur with that? Do you have any experience with SBA helping companies?
Yeah.
Do you throw it in your mix?
Yeah, we the SBA has been a critical resource for us as we've grown our business. We provide on our consulting side, that's our most active product, is the SBA 7A vehicle. And to build on what Seth had explained, there's positives and negatives about, I guess, every program, but within the SBA, the positives are that it provides what they call permanent working capital. The SBA lenders provide large lump sums of funding, and it's generally used for a specific purpose. The SBA 7A program, for example, some of the more frequent use of proceeds are partner buyouts, business acquisitions, debt refinancing, large capital expenditures, real estate purchases, that type of thing. But what it doesn't give you is, and it relates, and it's a great tie into this whole overall conversation on working capital, it doesn't give you that day-to-day working capital, and in fact can become a hindrance to obtaining, as Seth indicated, day-to-day working capital. So it's important that whether you're working with someone like myself or Aaron or a CFO or advisory group, it's important that you're relating to a previous question about understanding what your needs are. If your needs are going to be to have working capital ongoing because you're a manufacturer and you're going to be capital intensive and you're going to need revolving lines of credit moving forward, you need to address that in many cases upfront with the person you're working with or directly with the lender that you're working with. If what I found with our clients is we've had the most success if we package it up correctly up front and we explain exactly what we're looking to do. So we're looking to buy out a partner and then provide, and the business will need a line of credit moving forward because that partner is no longer pumping cash into the business. Well, then you better make sure that you're packaging up for the SBA lender that you'll have the ability to do it. Again, if you do it up front, it's very much an easy process. However, if you do on the back end, it is definitely in the eyes of the holder. Some banks make it fairly easy for clients to obtain working capital with quick subordinations. Others don't. I found that many of the non-bank SBA lenders are much easier to work with in that framework in providing access to additional capital. And I guess one other thing to add would be in the last 2 to 3 years, we're seeing more and more requests actually come from the SBA lender to make sure that the client has adequate working capital. So as part of a closing requirement, they actually have to obtain a line of credit because they don't, the SBA, again, is not a good source to go back and get lump sums of cash over and over again. It's good for a one-time need or another one-time need that might pop up. There's nothing that restricts you from getting multiple SBA loans. So you could start off with one project and then move to a different one. But again, understanding your needs is key to making sure that the SBA is an effective the SBA 7A program specifically is an effective financing product for a business.
It's interesting you say that. My experience with SBA loans, if it's a bank institution, they tend to bundle it with a line of credit. because they know automatically you're going to need it.
Yep.
And even the non-bank financial institutions will partner with a bank and get you a line of credit as well.
Exactly. I think we're seeing that more and more, and we're also seeing more working capital, thankfully, being built into some of these permanent working capital loans. So, for example, if you have a specific need of $1 million for whatever one of those projects I spoke about before, we'll see that maybe a loan's increased to $1.2 million. So there is some buffer there, versus a couple of years ago it was much harder to get access to working capital. I think again, I think it's environment driven, and in this environment, it's key to have either the banks bringing in the appropriate resources or working with someone that can aggregate those resources for you.
Terrific. So Aaron, building on that too, I'd love your comments, but do you feel that SBA financing is increasing, decreasing, slowing down, speeding up? What do you think there?
It's been, I've seen a lot more requests for it, for some of our partners, because obviously the guarantee is something they feel that will help them with a traditional bank, get them, a lower rate, help them a little bit with their, with their future cash flow needs, because it is going to have less interest they need to pay. What we've tended to see so far is that, at least in the last few months, is that there have been some, I wouldn't say loosening, but some of the requirements that need to be met can now be met from our partners. And so it seems to be that it's opened up a little bit more, but I just think coming out of the pandemic and some of the cash flow issues that people have experienced with, not just the reduced foot traffic for certain businesses, but also the lengthening in time of, receivables being paid, that it is now returning back to normal. And it feels like it's 2019 again, I guess, if that's okay to say.
Well, since we're pulling out of the situation, I think it's okay to say just about anything nowadays. So,
yeah.
With that. So what you're all saying is I should apply for an SBA loan for my business tomorrow, basically. Yeah. Okay, perfect.
The worst you're going to get is a no. I mean,
what did you say, Aaron?
The worst that you're going to get is a no.
Oh yeah, and I get that all the time. So it's perfect.
You're in the same position now as you were before.
So I'm going to switch. As you guys know, I'm heavy into mergers and acquisitions. I do a lot of advising around there. So the next question came up to me, and it says, what are the best products and programs to facilitate business acquisitions? Seth, would you mind jumping in on there and giving us your opinion?
It all depends on the company. And I'll give you an example. We're doing an acquisition right now where our client is heavy on receivables. They've got a bunch of telecom equipment, which is very hard to lend against. They are acquiring another company that has a ton of receivables, and we are looking at doing that facility almost exclusively as an AR line. That works for them. Doesn't work for all companies. Some companies, they can go to the SBA, which is a good choice. They can go to asset-based lenders because they have the proper assets that can be lent against. It really just depends.
Darren, what do you think about that? Who would you go to if I came to you and said I need funding for an acquisition?
Yeah, so it's a great question, because I think it depends on a couple factors. The first major factor for me is understanding the type of acquisition, the business that's being acquired. As Seth mentioned, is there a potential to do it using the receivables, because it's a heavy receivable-based company. What I found to be the most effective for small business acquisitions, up to about $5 million, is actually going back to the SBA 7A program. The reason I really like that program, and we do a ton of it for our clients, is because it requires a very little amount of equity injection from our clients. You can perfect a business acquisition with as little as 10% down. In fact, you can even go as low as 5% if the seller is cooperative and holds a corresponding note. And so it opens up by not being forced to put much equity down. It can open up a much larger amount of clients that maybe wouldn't consider buying a business to begin with. The other reason I like the SBA 7A vehicle is, again, because it sets up on a term loan where you have a payment that you know what the payment amount is going to be each month for the term of the loan. And oftentimes, because of that SBA guarantee, lenders are able to make those loans at very aggressive rates, even in this environment, over 10 or 25 years if there's underlying real estate there. So when I look at an acquisition for our clients, if it meets the SBA eligibility criteria, that's where I like to start. And then we can always build in revolving capital on top to help them with post-closing needs. But it depends. If, for example, if there's an inability to get a personal guarantee because it's private equity backed, or there's reasons that makes it SBA ineligible. And so then you have to pivot to other programs. But my focus has always been, if it's an individual or family or group of individuals looking to buy a business, if it fits under the SBA bucket, I always start there because of the benefits of the program and the flexibility on the amount of cash that might be needed from our clients.
And following on, Darren, is the 7A program, if I wanted to do multiple acquisitions, could you do that with the 7A program?
That's a great question. You can, and that's the beauty of the program as well. So I have clients we've actually gone through multiple acquisitions using the 7A program. As long as you're keeping your total SBA dollars as a individual at $5 million or less, you can acquire multiple businesses. I have a client now we're processing for his 6th SBA loan. They've all been fairly smaller loans. So as long as you keep that cap, and as long as the metrics of the company work from a cash flow perspective, and it makes sense on why they're acquiring the company, then you can most definitely use an SBA loan multiple times to acquire businesses.
Terrific, thank you. And Eric, I'll come to you. It's relatively the same question. SBA vehicles, are they good to use for these type of activities, and what do you feel about them?
Yeah, to Darren's point, it's one of the best ways to get it done if you're able to meet the requirements. As long as you stay under the cap and as long as you're able to meet the requirements the program puts in place. I like to have our partners get something like that just to offset some of the capital need that they've got. It helps them as a business. But as long as you're able to get one, I would say go ahead and get it.
Terrific.
And Don, if you don't mind, I'll add one more thing. I think it's important for the audience to know that we've painted quite a rosy picture of the SBA. There are parts of the SBA program that can be very challenging for a small business owner. The main issue that we see with the SBA program and our clients is the SBA's collateral requirements. So the SBA provides a directive called the Standard Operating Procedure to its various lenders that are authorized. And within that, it provides guidelines on making loans. Now, one guideline that they provided to lenders is that the lenders need to take available collateral. So what that means is if there is collateral on the business side, that gets pledged towards a loan, which most business owners are not unhappy with. But if there's not enough to secure the loan and the client or borrower has equity in a home, for example, the SBA can actually mandate that lender gets a second mortgage on the home or a second lien on the home. And obviously that can be a much different conversation because what the SBA does is it is a business loan program, but it most certainly ties into you on the personal side. So asset light businesses that apply for SBA loans or acquisitions, oftentimes, if there is collateral available from the borrower, they will require them to pledge that collateral. Again, much different conversation to just getting a small business loan. So I wanted to share, that to me is the biggest pitfall of SBA lending compared to conventional lending.
And I've seen that as well. I just finished up an SBA deal. They had a full building as collateral, but they required anybody that had 20% or more ownership of the business to put up more collateral on the back end. So sometimes the collateral can vary. Seth, what do you think about that? Have you seen SBA deals where they require a lot more collateral than you'd expect?
I have, absolutely. And I helped my brother and actually used Darren to help on that as well. And he ended up he had to put up as collateral a house that he owned, even though it had a mortgage on it, but he had significant equity in it, he had to pledge that house into that loan.
Right.
Yeah.
So you talked a little bit, Darren. I'm going to use what you said, and I'm going to ask another question that's probably going to open up a big can of worms in today's economic and business environment. But interest rates, we are starting to see, and of course the yield curve kind of inverted a little bit there for a while, but we're starting to see interest rates rise. SBA loan rates are still down. Aaron, what do you see? Can you put out your crystal ball and tell me what you think about interest rates and how they're going to impact your packages that you send out and companies coming for money?
Yeah, I mean, we're forecasting, basically along with what the Fed has been saying, excuse me, which is that rates are going to rise, anywhere between another 50 to 200 basis points over the next, year and a half. We've already seen the biggest rise that they've had in 20 years at a quarterly meeting. I think the way that we're looking at it is as we're going to more floating rate loans, we're predicting that, they're going to come out of, whatever our applicable margin is, you're going to come out of that and probably see, some, 100 to 200 basis point increase on your rate over the next, again, 12 to 18 months. And that, that's, I guess, at a minimum right now. The last time that the Fed talked about this was 3 or 4 years ago. They said they were going to raise rates. They've raised them, I think, 50 total basis points, and then they fell right back down. So we'll see if this actually holds this time. But, our expectation is that it will, and that we're going to see those rates rise, and we're going to see them, for the most part, always trail and harm the one at the end first. The last person in the chain, they're gonna see their rates rise, but they're not going to be able to increase their charges up front just yet because their bills are already going to be outstanding, for either 30, 60, 90, 120 days, whatever it may be. So they're going to be getting paid on a delayed cycle, which just means that they're going to have to be more prepared to have a little bit more of a war chest, a little bit more of additional cash on hand, or at least be prepared to how to deal with it. So definitely something to think about. We haven't gone full apocalyptic on it yet, just because we only think it's 200 basis points, but we do think it's gonna, that we're telling all of our partners to go through the exercise of, well, when do you think you can raise, when, your prices, when do you think you're going to get payment? Do you think you're going to get squeezed because the person who's supposed to pay you is getting squeezed by the person that's supposed to pay them, and just sort of the downflow channel. So.
Well, in M&A deals, cost of capital is huge in calculations, especially around discounted cash flow and other things. Seth, I'm going to add, first of all, do you concur with the rates going up? What do you see out of that? And what do you see a company should do if they're thinking about going after financing, especially around rising interest rates?
Well, I think, first off, I think that what Aaron said is spot on. I do think we're going to see interest rates go up 100 to 200 basis points over the next year or so, 18 months. I think companies, when they're looking for new financing, they need to figure that into their calculation. One of the things we haven't touched on here is, particularly with commercial bank loans, asset-based loans, you have debt service ratios that you have to adhere to. And as interest rates go up, that means your debt number goes up, but is your EBITDA number going up at the same time? And you have to really take into consideration your pricing as your interest rates go up. Otherwise, you're gonna bust through that debt service covenant.
Yes, I mean, to me, we do some. Even if we're not selling or buying a company, just in planning for the future, because you go in and you say, well, my cost of capital is going to raise, so I start looking ahead of time of what payments I'm going to have to make and how I'm going to get my money in. Aaron, coming back to you for a second, and then Darren, I'm going to ask you about rates. But Aaron, coming back to you, a lot of our participants may not be familiar with the term basis points. Would just explain that real quick.
Not a problem. So, excuse me. 1 basis point is 1/100th of a percent. So 100 basis points is 1%. So if an interest rate goes from, right now, let's say your interest rate is 6% on a loan, raising 100 basis points would mean you're going from 6% to 7%.
Okay, thank you. I just figured, I learned it in corporate finance class, but I wanted to make sure our participants knew what that meant.
Yeah, totally get it.
So Darren, what's your prediction? 500 basis points, 1,000 by the end of the year? Where are you at?
Gosh, I kind of, in my view, I wish they would, and maybe this is a contrarian view on it. I wish they would sort of rip the Band-Aid off and just do a large increase now. There's the sort of the macro environment that we're in, and everyone who watches has seen the stock market and the effects of kind of this dripping. Everyone knows rates are going up, but it seems to be being done in a drip fashion. It's interesting because yes, businesses should be concerned, but it generally goes in lockstep. And what I mean by that is, as a lender, it affects me. I borrow. I just, like most lenders do, I borrow money and I just lend it out at a higher rate. So now my cost of capital is increased and I pass it through to our clients. So in most cases, the rates rising, the entire environment rises together. So and we're in an inflationary environment as well. So that while you have all those forces moving together, I'm not as concerned. As soon as you start to Seth touched on it, whether meeting debt service coverage ratios, or you get into some sort of deflationary environment, I think that's where things can get a bit concerning. Because then it becomes a lot harder to meet those ratios, and banks start to have issues with clients and that sort of thing. So as far as a crystal ball goes, I would side to what Aaron said, but until they get inflation under control, which is just a major tax on small businesses and consumers, until they get under control, there might not be a defined ceiling in our near future, sadly.
All right, so now I'm going to go back to Seth, and I'm going to test your knowledge here a little bit.
That's a little scary.
Interest rates, when they raise them or lower them, they're typically in response to hedging inflation or keeping inflation under control. So, and we all know that inflation hits savings the hardest. So in other words, if a company has a lot of cash on hand, it's worth less because they are going to not be able to spend it on, they have to spend it on ever increasing price of goods. So with inflation going up, and I don't see an end to that, maybe your crystal ball can do that. What do you see the impact on lending or just some type of financing? Do you think that that's going to change things?
I do. I think it's going to change it a little bit because, and we've touched on this already, as rates go up to curb inflation, it's going to make it more difficult for companies to access capital, either just because lending, it becomes a little bit more stringent, and also because the cost is going up. They may not qualify for some of that lending anymore. So I do think it's going to have an impact. Whether or not how much it impacts inflation, I really can't speak to, but I do think it's going to have an impact on companies' ability to get loans going forward.
And Aaron, switching that gear, I'm going to test your knowledge as well. I kind of have a rule of thumb that if I'm going to, let's say, recommend an acquisition of a client, that their net income or EBITDA increases faster than my projected inflation. The reason I do that is just, again, to keep in front of it. Is that important in some of your decisions?
Absolutely. Any time you're going to do, particularly in an acquisition, if you think that you're going to buy something and you're going to sort of hold steady today, but you expect inflation is going to rise at a faster or even a much faster rate, you're basically not adding anything accretive to the, anything beneficial to your existing business. You're essentially, you might be making it look like it's bigger, but it's not really helping you because of the inflationary effects. Making those net income dollars in the future worth less, particularly as interest rates are rising.
Sure.
We look at not just inflation, we look at interest rates, we look at, what we think margins and spreads are going to be as we do forward flow, reviews. just to get back to it, some of the basic things when you're doing M&A or any sort of, de novo openings or expansions are making sure that you're forecasting as close to, expected as possible, and not just thinking sort of, pie in the sky, like, well, I think net income will grow, 40% over the, year over year, when it's actually going to be closer to 10 or 15, or even 3, because if inflation's at 8 right now, I think, that 3% means you're sort of lagging behind.
Yes. All right, Darren, I won't bore you with an inflation question. I'll move on to something else. We just got a question across that said, what does or what should an accounts payable aging look like for a company with poor working capital? And what is the impact on the operation of the company?
Gosh, so what it should look like for a company with poor working capital, generally we like to see that our clients are having their vendors at least within 60 days. And it depends if the clients do have extended terms with those vendors. What you would generally see with a business that does not have access to working capital or that's constrained is you'll see some of those payables creep into the 90-day and up column, and obviously that gets concerning for us as you can if a couple of the vendors get together, they can kind of force an action on the company. But we try to, circling back to one of the original questions, we try to meaningfully impact the working capital picture by providing resources for companies to go ahead and take care of those payables. Without paying payables, it's tough to get supplies in. It's tough to get labor. It's tough. You don't want to end up in a situation where you're on COD, because that further sucks through the working capital. So as part of our analysis and assistance to our clients, it's a big part of it is how do they maintain their payables ledger, and what programs are we providing that's going to continue to help so that does not become an ongoing issue. I will say it's probably the most dire issue that we see a small business go through is when those payables become stretched. You end up sort of robbing Peter to pay Paul. And very rarely, unless you get a liquidity boost or you haven't accessed working capital prior, now you can, very rarely can you just get yourself out of it in the normal courses of business.
Well, there's quite a bit to do with timing with accounts receivable as well. And I'm familiar with that where, and for those people that don't understand, what Darren was saying with COD is you take a few of your payables and you keep stretching them out. And the vendor comes back and says, well, I want to be paid before I ship anything else. And that is definitely a sign that your working capital is way too low, in my viewpoint. Aaron, do you concur with that? When you see companies come into you, you see you see accounts payable going one way or the other. What do you do and what do you recommend?
Yeah, I mean, absolutely. We've seen that. I think the problems that anybody experiences when they're short on cash and need to be able to continue to pay, current bills that they've got, the electricity, utilities, rent, payroll, those kind of things. They, sometimes we'll prioritize over paying an invoice that could go an extra 10 or 15 days past due, because that's not going to affect the immediacy of it. And unfortunately, you're just trying to pay something to keep the business in operation. I am 100%, with Darren that, you've got to understand what the cause of it was, and one thing that I think, as we've seen people who've come into us, they don't understand because they look at their accounts, they might look at their AR and their AR has gone up, sort of lockstep with their AP. And, if they understood their life cycle and could try to put some pressure on their customers, they might be able to help solve some of it. But for the most part, it's not fully understanding, what their life cycle of cash is and when they need to pay bills. And, if they've got POs that are due now and invoices that are due now that are for future generated revenue, it makes it a little bit hard. And again, to Darren's point, it's hard to dig out of that hole organically. You probably need some help, and if you can get the wheels back on, then you can, but it's going to take a lot of effort to sort of dig out of that hole, so that if you do have to go to a COD position, all of a sudden you've got the added burden of finding the working capital And then in a rising interest rate environment, you might have a little bit more of an increase in interest you got to pay. And, back to Seth's point, you might have some interest covenant, interest coverage or debt service coverages that you have to maintain. And it really does, sort of harken on the need of having a partner that can help you get through that and understand it and knows what the problems are and have seen it and have helped others work out. Sometimes you just need a steady hand to help you get through some of those issues.
And Don, if you wouldn't mind, I'd love to add on to what Aaron just said. There's the one key item that we haven't discussed is that there are actual products that can help a business navigate the payable situation. So there's products like what Seth and I do in the accounts receivable financing and factoring side and asset-based lending that can help maintain the payables. But then there's actually specific products that are generated to help either paying payables or buying payables from a client through supply chain financing, which is kind of a fancy word for almost an upfront way to assist with cash flow needs by paying vendors and that type of thing. So, while it can seem, daunting as a small business that you have, you've accumulated now payables under the scenario that Aaron had mentioned where, you needed to keep the lights on and you weren't able to make a vendor payment. There are programs that can come in and you can leverage to cure those problems without having to dig out of it yourself.
Perfect add-on. That makes perfect sense. Seth, did you have some comments you'd like to
Yeah, you asked what does the payables look like when a company has poor working capital? It's usually a mess. If they have really poor working capital, it's a hot mess. And a lot of times it's not because it's a bad company or a failing company. It's that because they haven't accessed some of those products that Darren just described. And by doing so, you can very easily clean up your accounts payable. By not doing so, you not only miss out on discounts, you not only get yourself put in a position where you're paying for things on COD, but more importantly, your accounts payable clerk is doing nothing but talking to vendors all day long, working out payment plans, trying to live up to those payment plans. When he doesn't, it gets escalated to the controller and eventually to the owner of the company who's spending half his day talking to vendors, trying to work out, trying to stop from getting cut off. So it dramatically impacts a business and once your payables are a mess, your whole business is in fire alarm mode.
Well, I'm going to tell a story here. I had one client who got about 90% of their receivables were instantaneous, meaning they had credit cards and they got paid cash. But it turned out to be a big, huge problem, and their payables started having a problem because they couldn't shrink the AR cycle. There was no place to shrink it. So you can be very confident in getting cash in the door, but you got to be careful. As you said, Darren, you got to mix AR with AP. You got to figure out what that cycle is and the differences between them. I think that's very important. So thank you for sharing that. Going back for a second, somebody brought up a quick question here, and it's more of a definition question. So Seth, I'm going to come to you, even though I just ended with you. Can you define the difference between just general working capital and permanent working capital and what that means for a company?
It's going to be a better question for Darren, but to me, general working capital is just what we see, to deal with accounts payable and those types of things. Permanent working capital is a loan that you brought in that's not an ABL, it's not a line of credit, it's a term loan that you have taken on to deal because you projected out what your working capital needs are.
Sure.
Yeah. Like
Darren,
I know Darren deals with that a lot. I would ask him.
Yeah, Seth described it perfectly. It's permanent working capital is kind of just a way that we've encountered that SBA lenders call working capital, where it's sort of that one-time distribution or that one-time usage of it. It's funds that get utilized to, as I mentioned, buy a building, buy large pieces of equipment, buy out a partner, acquire a business. The various SBA processes generally fall under that. It's just one time versus ongoing. Ongoing working capital is generally revolving in nature and ties to this whole conversation about AR and AP and keeps up and with the growth of a business, or in some cases also decreases when a business just doesn't need it, which is kind of one of the nice features of various forms of asset-based lending. You know, it comes up quite a bit where, you know, a business is concerned, well, if I take out a loan against my inventory, let's say, you know, how do I pay back that inventory loan? Well, if you're under a true revolving structure with a borrowing-based certificate, which is a form that shows what you've borrowed, what you've replenished on your inventory, that your availability on your inventory, it will be self-governing. So as inventory goes up, you're able to borrow more. When inventory is sold and not replenished, it automatically goes to pay down your loan balance. And so it ties again to another item that we talked about, in how does a lender help a small business owner kind of manage the business, other, you know, non-paid services. This is one of them. This keeps your borrowing in check. It keeps your growth in check. And if things decrease, you're not just borrowing an exorbitant amount of cash without a use, if you're under a controlled revolving structure.
And Aaron, I'm going to come to you, but I want to say to the participants, both online and offline, thank you for your questions. If you have any additional questions, please type them in the box so we can get them to the panelists. Aaron, so let's go to you. Same question. Do you, and I'll expand it, company comes to you, do you look at them and say, well, you need a little bit of permanent working capital and a little bit of general working capital, or how do you make that decision? How do you give advice around that?
You know, it's going to depend on each, you know, again, each business is different and unique, and they might have their own challenges at that point in time that they come to us. I believe that, that having some sort of permanent financing, definitely, not just from a cash flow ease, but sometimes a psychological ease, will help our partners understand, okay, this isn't something that's going to go away tomorrow. They know that they've got a longer time frame to do it. It's not something that fluctuates as much. It just helps, sort of break out and separate what the way to, to get to a better capital position. A lot of times we'll have the conversation of, how do you eat an elephant? You got to start with the first bite and one bite at a time. And, sometimes it is a big ditch to get out of, and sometimes it's not. But if it is, start somewhere. And if we can structure something that's got, permanent and floating and revolving type of debt, getting anything to help structure it today, where we can then see, 6, 9, 12 months from now, you're in a better position. That's what we're shooting for.
Okay. Those are the questions I had on hand from the participants. I was going to turn this for a second. If you don't mind, Seth, I was going to do something different. Do you guys have any questions to ask a professional CFO around this topic? And professional CFO, I meant me, in case you got confused.
Sure.
Yeah.
Yeah, I have one. If we're opening it up to the floor, I would, Don, I'd love to know, how do you pick your when you're acting as a CFO role, how do you pick your lending partners? Do you go through an advisory group? Do you have a list of lenders you work with on a regular basis? What's your method when working with your clients?
Well, that's a huge question, Darren. I would say that it really varies depending on the client. The very first thing I do is just assess, probably very similar to what you do. I assess what their needs are. In this particular case, we're talking about opportunity capital and working capital in general. If it's a merger and acquisition, I do have some people I go to for debt financing, for equity financing, and so on. Of course, I'm always expanding that list. I tend to keep a list of lenders and equity partners that fit the needs of what I'm trying to do. So I don't, again, I could come to you, Darren, and I could say, listen, I need an ABL on this and this and this, and I know ahead of time that you don't do that. It's just wasting both of our time. So I try to find people that could work with. Now, I also have people all three of you that I'll come to and I'll say, hey, listen, I got this problem. I need X, Y, and Z, but I'm not sure how to do it. And I work with you, your type of firm, to help you find the right answer to it. Now, if it's a straight 7A or 509 kind of loan, those I can typically go to an SBA lender I know. But the market shifts quite often. So it really depends on what the firm out there that can help and do the needs. But that is a challenge, though. It's interesting, if I can expand that. There's so many lenders, there's so many equity partners, there's so many advisory firms. It's tough to get in front of all of them, keep track of all of them. And that's one of the trouble I'm facing right now. Except for you three, because I got you on the top. You're on speed dial now, so
Perfect.
definitely.
I got a question for you. When you're working with a company, you're making a decision if you should advise them to go out and get debt financing or go out and get equity. Which one do you feel stronger about? Would you prefer to see a company bring on more debt financing, or do you think it makes more sense for them to bring on more equity?
Well, my default is debt financing. I'm going to be right up front with you. Now, let me caveat that. If they already got a ton of debt on the books, I don't go that route. If they've already got issues with collateral, I don't go that route. I know pretty quickly, and Darren brought it up earlier, if you don't have the collateral for an SBA loan, there's no use filling out the SBA paperwork. It just doesn't work. I kind of prefer debt financing because it's more stable. Debt owners tend to look at themselves as more stable, more secure, and then I fill in with equity afterwards. Now, of course, if you're I've got several high growth companies now, R&D companies, they're not going to get debt financing except for asset-based lending, perhaps, or maybe something like that. But for expansion capital around that, I definitely go for equity financing. So it comes back to it depends. It depends on what stage the company is in, what life cycle they're in, and what they already have on their books.
Good.
And I'm going to ask one other thing. When you get in, on a temporary or sort of semi-permanent basis to help somebody, what's one of the first things that you look at from, a cash flow review to see where they're at? How do you get in so that you can understand their cash life cycle?
Well, it's interesting. I'll take that. The very first thing, and maybe I'm different, but very first thing I look at, I don't even look at an income statement or a balance sheet. I look at a cash flow statement. It's very first thing, and I want as detailed as possible. That tells me where they're spending money. It tells me how fast their AR and AP are being adjusted from month to month, and I look at month to month to find out. And that gives me a pretty good picture within about 5 minutes of what's happening. Then from there, I go in and just look at are they right sized on their debt and equity financing. I look at their balance sheet, then the equity portion long term, and I just make sure that they're in the right place. Again, another 5 minutes, and I usually have a pretty decent picture of where they're at. And that's whether it's a $500 million manufacturer or a no revenue, pre-revenue R&D facility. I can usually gauge pretty quickly with those two items. And then, of course, I start diving into AR aging, AP aging, intangible assets, stuff like that on the books, and make sure that there's no, I hate to say it, no shenanigans. That's my word for the day, a shenanigan. But, that's what I kind of look for, Aaron.
And just
I'm going to check here for questions for the.
I was just going to say, I just have one quick follow-up on that. So when you hop in, and by the way, I completely agree on taking a look at the cash flow statement. Typically when somebody, when any partner comes in or company comes in to have a review because they need help, I'll take a look at their cash flow statement because that gives me the best understanding I can of where their capital is going over the last 90, 180 days, just to see what the flow is. When you do see issues or problems, how do you note those and then go about tackling them if you see that they aren't right sized or if they've got bloated expenses in certain areas? What are some of the good first steps to do to tackle that challenge of trying to tell somebody, hey, you might be spending a little too much here?
Well, I'm going to be a little careful here and try to be diplomatic, but I'm kind of an emperor has no clothes type of approach. I typically pull the owner or pull the equity holders into a room, and I tell them right up front, listen, here are your 5 problems. Here are your 10 problems. If you don't fix them right now, you're going to have an issue. That's assuming, Aaron, of course, that they're really bad, and I can pick them out. But you get AP averaging at 90 days, and it keeps increasing by 5 days a quarter. You get AR, shrinking. You get some going past the 60 and 90-day level, which is discounted heavily. I go to them and I'll say, okay, listen, here's your biggest problems. We're not going to be able to get a loan. We're not going to be able to get financing if you've got such a discrepancy between your AR and AP. So I'll just pull them in a room and tell them right up front. And here's why I do that. Let me be clear. The faster you address the problem will tell you whether or not they actually want you to address the problem or they just want to get financing. And if they just want financing and they don't want to fix the problems, I don't bring them to an outside firm because it's just not going to work. You're going to look at the same thing I look at and you're going to say the same thing.
And Don, that's a key point. And one of the major things I ask our clients to do we always do sort of an interview call with our clients is just tell us the good and bad and the ugly. We can generally solve around it, but don't withhold anything in the to try to get approved for financing. It's generally going to come up, but if we know up front what the issues are, we can navigate them. If there's tax issues and you're on a payment plan, you can actually still close, but despite many SBA lenders not wanting to do it, you can still close on an SBA loan, personal and business. If there's legal issues that need to be resolved or understood, we can do it up front and present a better picture for financing. So I just think it's key for our team during our interview call. It's the very last question that we ask, but it's probably the one we spend the most time on if there is some type of issue, understanding the issues and navigating them ahead of time so that there's no surprises during underwriting.
I'm going to expand on that a little bit. And the reason I was smiling when you were saying that, Darren, is my initial calls with a lender for a company are usually really short because I usually just pick up the phone. I'll go, hey, Aaron, or hey, Seth, or hey, Darren, I got this company. Here are the 5 good things. Here are the 5 bad things. Here's what I can control. Here's what I can't. Can you help us? You either say yes or no, and that just shortens that cycle so much.
Yeah.
That you can just tell right away. And I'm that type of CFO when I go into it, not to grow it myself, but I just find it just gets things done much quicker.
Yeah, and I think you're talking to you're talking to non-bank, both non-bank lenders and advisory firms here. And non-banks are much more amenable to getting across some of these issues ahead of time if they know about them ahead of time versus a bank that might you might have a decline right away if these issues come up. So it's also important to know your audience. But yeah, being upfront, I mean, it saves everyone time, energy, money, resources, that type of thing.
So we're here at near the end. Are there any other, I don't have any questions from panelists. Thank you, panelists, for so much, or participants. I don't have any further questions. Thank you for participating. I'll talk to the panelists. Do you have any other comments or questions you'd like to share with the group before we end up?
No, just thank you for doing the great job you did, Don.
Yeah, Don, appreciate
I aim to please.
Yeah, thank you for moderating.
We thank you all.
Appreciate it.